Joining us now, Sam Stovall, Chief Investment Strategist at CFRA Research. Sam, great to talk to you. Are we thinking that it's just the kind of negative seasonal tendencies or just something in the markets under the surface that seems like maybe there's some fatigue there or something else that you're trying to flag?
Hey, Michael, good to talk to you again. Well, I think it's a combination. If you look just to October itself, it is by far the most volatile month of the year, with 33% more volatility than the average for the other 11 months of the year. So from that perspective, it's basically fasten your safety belts. But also just before the Powell-induced plunge earlier this week, the thought being that, let's take a look at where major indices are trading versus their 200-day moving averages. And the S&P 500, the Russell 2000, the S&P Developed International, as well as communication services and tech were more than one standard deviation above their mean. So implying that they are due for some sort of digestion. Plus, they all but the Russell were trading at an RSI above 70. So I think a near-term digestion of gains is certainly appreciated and hoped for by many investors.
That's a good point that it's hoped for. I think that's correct, Sam. If I kind of just look across the landscape at how people are approaching this moment in the market, it's don't be surprised if we do get some kind of a pullback. And we have not had a 3% pullback or greater in the S&P since April. So obviously, we might be due. On the other hand, if the market, as we were just discussing, kind of resists the opportunity to go down a lot, it feels as if people are just penciling in the year-end rally no matter how it goes.
True, and also you have to realize that the S&P's all-time high was then matched on the same day by the Russell 2000, and also we had an all-time high set on the S&P Developed International Index. Historically, whenever you've had an in-concert move to the upside like that, we have had 2 to 3 times the average performance over the coming 90 days, with a frequency of advance that, at least for small caps, went from 62% up to 80%. So higher frequency of advance, greater average advance, mainly because you have a confirmation around the globe.
Sam, are you a believer in the small cap rally at this point? I mean, some would say the quality of the small caps these days not as good in terms of the earnings quality, so they're doubtful, even with the advance we've seen.
Hey, Melissa. Well, I think that we are likely to see small caps play catch up because, as I just mentioned, they set their first new all-time high in 4 years, while the S&P had set 89 new highs in that time frame. Whenever both of them hit new highs, the small caps were up 2.5 times what they normally were, with an improvement in the frequency of advance. We're looking for 20+% earnings growth in 2026 for small caps versus 13% for the S&P 500. And the small caps are trading at a 35% discount to their 20-year average relative PE on forward estimates.
Sam, in a couple of weeks, we're going to hit the 3rd anniversary of this bull market, as most are measuring it from that low in October of 2022. Where does that take us in terms of the broad tendencies? I mean, a lot of the concerns that people are raising about this bull market is that it's very concentrated in terms of where the gains have come from and how the index is skewed, and also, obviously, level of valuation just across the board.
Right. Well, usually if we can get past the second year, as we are about to do, it's almost like child rearing, beware the terrible twos. So if we can celebrate our 3rd birthday on October 12th, then it's like demographics. You get past age 65, you've got a great chance of making 85, 95. So with bull markets, once you get past the 3rd year, then the 4th year average gain is 13% and a much greater frequency of bull markets continuing their run into that next year. So from that perspective, things are positive. I do believe, however, that we're going to need to see an acceleration in earnings expectations because we're still below what we were thinking we would earn in the S&P 500 on December 31st of 2024. So I think we still need to see an improvement in earnings.